What is risk management? Why do profitable companies suddenly collapse? Why do banks fail even when they look stable? Why do businesses buy insurance, install controls, and build emergency funds? The answer is simple. Risk. Every decision we make involves uncertainty. When you drive a car, you wear a seat belt. Not because an accident will definitely happen, but because it might. When you invest money, you diversify. Not because markets will certainly crash, but because they can. That thinking ahead, preparing for what can go wrong, is called risk management. Risk management is not about fear. It is about preparation. It is about making sure that when uncertainty strikes, you are not surprised. And in business, that preparation often makes the difference between survival and collapse. So what exactly is risk management? Risk management is a structured process of identifying potential threats, analyzing how serious they could be, and putting measures in place to reduce their impact. There are 4 simple steps. First, identify what can go wrong. Second, assess how likely it is and how damaging it could be. Third, implement controls to reduce the impact. Fourth, monitor continuously because risks keep changing. Notice something important. Risk management does not eliminate uncertainty. That is impossible. Instead, it reduces vulnerability. It transforms random problems into manageable situations. It converts surprises into prepared responses. And that structured thinking is what separates stable organizations from fragile ones. Let us make this even simpler. When a family buys health insurance, they're managing medical expense risk. When a student studies before an exam, that student is managing performance risk. When a business backs up its data daily, it is managing technology failure risk. In all these cases, the event may never happen, but preparation reduces consequences if it does. In business, risks come in many forms. Financial risk, operational risk, legal risk, strategic risk, reputational risk. A company launching a new product faces market acceptance risk. A bank giving loans faces credit risk. A hospital faces regulatory risk. Risk management means asking one powerful question: what can go wrong, and are we prepared? Now let us look at how companies apply risk management. In a professional organization, risk is not handled casually. It is structured. Operational teams identify process weaknesses. Finance teams monitor liquidity and funding stability. Compliance teams track regulatory obligations. Senior management integrates all of this information and evaluates whether the organization is taking more risk than it can handle. This is where risk appetite becomes important. Risk appetite defines how much uncertainty the organization is willing to accept in pursuit of growth. For example, aggressive expansion without adequate capital is risky. Entering a new market without understanding regulations is risky. Risk management ensures that growth happens within sustainable limits. It connects ambition with discipline. Many corporate failures were not caused by lack of opportunity. They were caused by ignored warnings. Companies sometimes expand too quickly. Banks sometimes underestimate borrower risk. Businesses sometimes ignore compliance requirements. In most cases, the warning signals were visible, but there was no structured system to identify, escalate, and respond to those signals. Risk management acts as an early warning system. It highlights concentration exposure. It identifies funding mismatches. It detects operational weaknesses. Without it, small issues slowly become major crises. With it, organizations can correct course before damage becomes irreversible. Here is the most important point. Risk management is not about avoiding risk. Every business decision involves uncertainty. Growth itself involves risk. The goal is not zero risk. The goal is controlled risk. Strong organizations do not eliminate uncertainty. They measure it. They monitor it. They manage it within defined boundaries. In today's world, with technological disruption, regulatory changes, economic volatility, uncertainty is constant. The difference between fragile organizations and resilient ones lies in preparation. Risk management is that preparation. It transforms uncertainty into informed decision-making, and ultimately, it builds long-term stability in an unpredictable world.